Welcome back. We are doing a stock analysis on Activision Blizzard, which to me is also going to be like taking a trip down memory lane. You know, if I would have invested all my time and money that I spent on Activision Blizzard games, I would have missed out on some fun experiences as far as playing video games go. That's all I got to say about that. All right, so I'm going to quickly look at the share price history. Then I'm going to look at the 2021 Q3 PowerPoint that was put together by Activision Blizzard. And then we're going to go through the financial statements and then finally come up with the valuation at the end. So look at this one-year trend. They were flatlined for a while and then had a fall all the way to, let's see, a fall of 40%. Wow, all the way to $57 a share, and have since recovered a little bit. Most of that was due to some negative news as far as lawsuits for sexual harassment stuff. I don't know the full details about it, but I know this is going to sound bad, but usually that stuff doesn't affect the underlying business financials, so it can present a good buying opportunity. I know that sounds terrible, but it's true. All right, so enough of that. Let's look at their Q3 PowerPoint. All right, so here's their Q3 2021 PowerPoint. You can just pull this from their website under the Investor Relations tab. All right, so I want to show you this first. Activision Blizzard really makes their money off of three different groups. So the first one is obviously Activision. That's in the name. And the main one here is Call of Duty, right? And Warzone. All right, next, Blizzard, also in the name. Things like Diablo, Overwatch, World of Warcraft, Hearthstone. And then finally, what a lot of people don't know is King, which makes Candy Crush, okay? And look at this real fast. Revenue grew 22% year over year to a new quarterly record. That's pretty good. All right, and then I want to show you this too. So what I'm going to show you is their Q3 segment results. So Activision, Blizzard, and King. So look at this. Of the three, King actually is making more money than the other two in operating income. So I know this because I looked ahead a little bit, but their total operating income for the quarter is something like $830 million. So Activision makes up 30% of that, 244 divided by 830. Blizzard makes up about 22% of that, and then King is all the way 36% of their operating income is coming from King. That's awesome. That's something people don't really know about, and it's growing. Look, like I said already, growing 22% year over year, driven by Candy Crush, the king of mobile games, right? To be honest, I didn't even know Candy Crush was still a thing. I thought that was like 10 years ago. But I guess the same thing can be said for World of Warcraft, right? World of Warcraft were higher year over year. Wow. All right. Let's go to the financial statements. All right, first thing we're going to look at is total revenue, and we make sure this is growing, or at least not shrinking. And look, it's growing. That's great. Not getting a metric from that, just like to see it. And we're going to use operating margin here. I usually use operating margin for online or software companies, especially after seeing their PowerPoint. On their PowerPoint, they didn't value gross margin. They didn't value net margin. They valued operating income. That's what they were judging their three segments by. So always, if the company points out something that they like, you definitely want to use that as your own valuation or competitive advantage marker too. All right, so operating margin shows the company's competitive advantage, right? Because higher here than competitors would mean that it's able to sell for a higher premium and has that competitive advantage over everybody else. So look at this growing. That's awesome. And close to, if not over 40% recently. That gets a huge check mark. That is awesome. Over 40% operating margin and growing. That's crazy. We're also going to look at R&D as a percentage of revenue. So what this tells us is how much is the company having to reinvest to try to stay on the cutting edge of technology. And I know that this is a big deal for video game manufacturers, right? Top games can have super high turnover. So they're putting about 15% of their revenue towards R&D. That's pretty high compared to like normal companies, but they're in software in a constantly changing field. They have to keep up with the times. So I don't mind seeing that. What you don't want to see here is if it's growing a lot recently, it means that they're having to sacrifice a lot more of their money into keeping up with the Joneses kind of. So this is good that it's kind of flatlined, even with a growing revenue. So really like to see that too. Another big check mark. Okay, let's get pre-tax income, and we're going to get a number here. I got to go back to dollars. Okay, so this is great too. Look at this. It's almost like on a little exponential curve as far as earnings go. Okay, so I'm going to take an average of these last 4 quarters and multiply by 4. So the average of the last 4 quarters was, or I don't need to take the average. I'll just sum them. So the sum of the last 4 quarters was $3 billion, $3.1 billion. So that's going to be what I put for my pre-tax income, 3.1 billion. I was about to average and multiply by 4 instead of just adding them together. That would have been embarrassing, right? All right, so now we got to get a growth rate. How am I going to do this? Remember, I always say go peak to peak, so don't go pit to peak. I'm going to go around this time frame here and say they were making, let's say, what is this, 430. So $430 million a quarter, 430 times 4 to give us a yearly number. So $1.7 billion for the year. And to get that annualized, I do 3.1 divided by 1.7. Okay. And then you're going to raise that to 1 over how many years? So we're in 2021 now. I picked, what was this, 2013? So that's 8 years, right? So we're going to raise that to the 1/8. All right, and we get a growth rate of 7.79%. So I'm going to say 8%. All right, awesome. Last on the income statement, earnings per share. Let's see. All right, I'm going to take the trailing 12 months just like I did for the pre-tax income. I don't know what this is all about. I don't like seeing that, but $3.38. That's what I got. So $3.38 for earnings per share. Awesome. Let's go to the balance sheet. Total assets is first. And what are we going to do with total assets? Real quick, I think this is that merger, just the Activision Blizzard merger. That's just my guess. Total assets, all we're doing here is we're going to use the total assets to get a pre-tax return on assets. And keep in mind, we're not doing tangible assets. Sometimes I do tangible assets. I'm not doing that here just because I want to show you something interesting. All right, so total assets come in right under 25. We'll say $24 billion of total assets. And then their pre-tax income that we said was $3.1 billion. So if I do 3.1 divided by 24, I get a pre-tax return on assets of 13%, 12.9%. That's awesome. I like seeing that. I like double-digit return on assets, especially if I didn't even subtract out tangible assets. So real quick, look at this. Look at their goodwill and intangible assets. It's close to, what is this, $11 billion? Yeah, close to $11 billion. So all of their assets, remember I said it was $24 billion, so 11 divided by 24, they're 45%, 46% of their assets are goodwill and intangible assets. So in a way, that's like half their assets, right? So you can think of their pre-tax return on tangible assets as close to double 13, so like 26%, which is just outstanding to be making that much return on your assets. But that's also kind of the pros of a software company. That's why people love software companies and video game companies, right? Low assets required. What's next? Debt to equity. Okay, so this is a good way to measure how levered a company is, you know, how much debt they have. What you do is you take the total liabilities and divide by equity, and you want this to be close to 1, if not under. And look at this. Wow. This is way under 1. This is awesome. So that means that they have a lot more equity than debt. So this is a great sign. I think that this shows that the company doesn't have a lot of debt. And if you did more detailed due diligence, you would see that their debt is super low, and I think that's just awesome. We love seeing that. That puts them in a great position to take more risks financially, to not have to worry about going bankrupt if they start losing some money. Low debt, always a good sign. All right, and then lastly, tangible equity per share. So I've defined this multiple times for y'all, but you know, this is all the assets minus all the intangible assets and goodwill minus the liabilities, and then take that and divide by the number of shares. And look at this growth. It's linear, it's not exponential, but it's still very consistent, and that is awesome. I really like to see that. We're going to get a price to book on this, tangible price to book. So we just take the current share price, 63.6, divided by 8, and we get a tangible price to book of 8. To be honest, for a software company or video game company, to get a tangible PB less than 10 is great. We got low debt, we get a good return on assets, balance sheet also gets a big check from me. Okay, let's go to the cash flow statement. This one's going to be fast. We're just going to look at two things real quick. Free cash flow. We like to see this growing. And one thing I always liked to see with free cash flow is that even though free cash flow usually has a lot of ups and downs compared to, like, let's say pre-tax income, you don't see negatives here like you see with other companies. So even on their kind of low cash quarters, they're still not bleeding cash. So I really like seeing that. It's a little all over the place. So what I'm going to do here, because I can't really judge it, is just take a average of, like, let's say the last 8 quarters, so the last 2 years. So if I average the last 8 quarters, I get an average of $594 million per quarter. So $594 million times 4 is going to get me a yearly estimate on free cash flow, and that's going to be 2.4. I don't know why I had 1.9 there. 2.4 billion. Now let's go to CapEx. All right, so look at this. I just wanted to show you this. This is crazy. So they're spending like $20 million on CapEx. 20 million. This is per quarter times 4, $80 million, okay, per year on capital expenditures, which is like reinvestments to keep up with your assets, to grow your business. $80 million, which is divided by their free cash flow is like 3% of their free cash flow. That's one of the lowest ratios I've seen. That shows that their assets are in good condition. It's really, that's awesome. You almost never see somebody who has such little capex. But maybe I'm just not used to software companies. Still, really neat. Wanted to point that out. Okay, let's go to valuation. All right, first one, pre-tax income times 10 divided by the number of shares. So 3.1 times 10, 31 divided by the number of shares, which we said is 779 million. So to keep it in billion, I'm going to do 0.779. And I get an average share price, or a target share price, of $40 per share. I'm rounding up. All right, next, we're going to do the Ben Graham formula. So that is our earnings per share that we got, 3.38 times 8.5 plus 2 times growth. So our growth rate is 8% in this case. And we get a share price of $83. Pretty good. I think this one really, it usually comes in on the high end, but like I say all the time, my other two are pretty harsh, so I kind of like it. It gives me a good balance. All right, and then lastly, discounted cash flow. So I'm gonna put my cash flow number here, 2.4 billion, and perpetual growth rate. I trust them to grow it at least, let's say 6%, and then I'm going to discount at 15% like I always do. And then I get a net present value for the market cap of 31 billion. That's crazy. I promise I don't plan that. That's the same exact number that we're going to get for the pre-tax. So 31 divided by 0.779, same thing, $40 a share. Wow. All right. So our average price target, less than the market price. I think I know why. I know why. The financials are great. You got low debt. You got a great margin. You got growing revenue. It's got a lot of check marks going forward. I don't think I saw a single red flag. That being said, this is a company I'm not going to be buying because it's not at a discount, or it doesn't have a margin of safety between the share price and my price valuation. I think if you bought this stock and you held it for 10 years, you'd probably be happy. But I also think that you'll probably get another buying opportunity. It's going to be on my watch list for sure. That's just my opinion though. That'd be how I would approach it if I was investing. Well, I am investing. That's how I'm approaching it. Anyway, I hope you learned something. I hope you enjoyed the video. If you did, please like and subscribe. I will see you next time.